Welcome to The Explainer. Today, we are putting on our daily financial news anchor hats to calmly and methodically break down this sudden, sharp drop we're seeing in semiconductor stocks and AI equities across global markets. If you've been watching your screens flash red lately and wondering if the whole artificial intelligence narrative is starting to unravel, well, you are in exactly the right place.
$25 billion. Seriously, let that sink in for a second. That massive number represents 38.5 trillion won in South Korean retail margin debt. It's a historically high level of borrowed money that essentially acted as the initial powder keg for the huge global market volatility we're unpacking today. It is a textbook example of what happens when extreme financial leverage meets a totally unexpected spark.
Here is our agenda for today. 1. The semiconductor sell-off. 2. Leverage and market rumors. 3. Institutional moves and rates. 4. AI's long-term reality. And 5. Investors' psychology and strategy. Let's get right into it.
Part 1. The semiconductor sell-off.
To really understand this catalyst, we have to tackle the exact question panicking retail investors are screaming right now. Is the AI hardware rally actually over, or is this just a routine, albeit painful, shakeout? To answer that accurately, we've got to strip away all the emotion and just look squarely at the data.
Let's trace the chronological autopsy of this crash. It moved almost seamlessly from a localized event over in Asia straight into the beating heart of Wall Street. It started with the KSP, South Korea's benchmark index, which actually triggered circuit breakers and plunged 10%. Heavyweights like Samsung and SK Hynix, which are absolutely vital to the global AI memory supply chain, plummeted by over 12%. And by the time the US opening bell rang, that proxy panic had crossed the Pacific, dragging the Nasdaq 100 down 3.3% and slamming the closely watched semiconductor index down by a brutal 8%.
Part 2. Leverage and market rumors.
You know, the market was fundamentally primed for a pullback anyway because of high valuations, but it only took a few really specific, unverified rumors to light the match. Suddenly, there were these whispers that SK Hynix was pivoting away from its advanced AI memory to focus back on traditional DRAM. Combine that with totally baseless rumors about delays in their ADR listings, which let foreign shares trade in the US, plus some political chatter about taxing unrealized gains. In a normal market, all of this is just background noise. But in a market pumped completely full of leverage, it triggered a massive cascading wave of forced margin calls.
The crucial point here is the downright absurd level of speculation that had built up. Think about this. You had miners opening 10 times the normal number of trading accounts. You had senior citizens actually liquidating their life insurance policies just to chase tech stocks on margin. When the market structure relies on that kind of extreme retail leverage, it becomes incredibly fragile. So when those margin calls hit, brokers just automatically sell off shares to cover the debts. It creates this mechanical, ruthless downward spiral that literally has nothing to do with the actual underlying fundamentals of the companies involved.
Part 3. Institutional moves and rates.
Zooming out a bit, this sell-off wasn't just a bunch of retail panic. We actually saw 3 distinct floods of mechanical, institutional selling pressure hit the market all at the exact same time. First, we had that retail margin liquidation we just talked about. Second was the June quarter end. This is when massive global pension funds are mechanically required to rebalance their portfolios, basically taking profits from high-flying tech stocks and moving billions over into bonds. And the third flood? Algorithmic Commodity Trading Advisors, or CTAs, hit their technical triggers, which unleashed billions of dollars of blind automated selling.
Adding even more fuel to the fire, we've got a major divergence in interest rate expectations right now. Bank of America recently dropped an extremely hawkish forecast, predicting 3 distinct rate hikes later this year. Why? Because core PCE, which is the Fed's absolute favorite inflation gauge, is staying super sticky at around 3.5%, and this heavily pressures AI valuation models. Think about it. Growth tech stocks are priced based on their future earnings. So when the cost of capital goes up because of higher interest rates, the present value of all those future earnings drops significantly.
On top of all that, reports are highlighting the potential return of the bond vigilantes. These are major fixed-income investors who essentially protest poor fiscal policies and huge government deficits by aggressively dumping bonds. When they sell, bond yields spike, and just like we saw with that hawkish Bank of America forecast, spiking yields give investors a risk-free alternative to equities. That directly threatens and compresses the sky-high valuations we've been seeing in tech and AI hardware stocks.
Part 4. AI's long-term reality.
Okay, let's take a breath and separate the daily panic from the actual facts, because a distinctly different picture emerges when you do. While day traders are losing sleep over daily price action and South Korean margin contagions, the long-term fundamentals are rock solid. Big tech cloud providers, we're talking Google, Meta, Microsoft, Amazon, they are relentlessly scaling their AI capital expenditures. They're projecting consistent growth over $100 billion annually in data center spending alone. This AI infrastructure race is universally seen as a must-win scenario. You either build it or you become completely obsolete.
However, we do need to keep a really close eye on what analysts are calling the rubber band effect. There's this growing and potentially dangerous valuation gap between the cloud providers spending massive amounts of capital on AI and the hardware companies, like the chip makers, who are collecting all that cash. If the companies spending those billions don't start showing massive revenue growth from their AI investments pretty soon, that rubber band could absolutely snap. They might be forced to slow down their spending, which would obviously take a severe toll on those hardware stocks.
We're also seeing this fierce optimization battle that poses a real future risk the broader market is just now waking up to. For instance, look at the new open-source models coming out of China, like GLM 5.2. These are reportedly operating at roughly 1/10 the cost of Western flagship models, while still achieving about 90% of the capability. If highly capable, ultra-cheap open-source AI becomes the global standard, well, the necessity of those massive brute-force capital expenditures by Western tech giants might be fundamentally questioned. This fear of a race to the bottom in AI pricing is acting as a very real, natural ceiling on hardware valuations right now.
Part 5. Investor Psychology and Strategy. Before anybody completely panics about a pullback, let's get some context here. Prior to this recent drop, the primary semiconductor index was up a staggering 117% this year. Seriously, when a sector more than doubles in just a matter of months, a 10 or even 20% correction is not a crisis. It's a healthy, normal, and frankly, absolutely necessary shakeout in a massive bull run. It flushes out all that excess leverage and sets a much healthier foundation going forward.
So here's your tactical playbook for navigating this kind of high volatility environment. Step 1, do not try to catch falling knives. Just wait. Let that mechanical, institutional June quarter-end selling finish washing completely through the system. Step 2, identify solid, deep technical support levels based on forward earnings rather than emotion. Look for levels where the math simply makes sense. And Step 3, deploy your capital in measured, deliberate tranches. Do not go all in trying to nail the exact bottom. Scale in slowly.
I want to leave you with this anchoring thought to keep your psychology grounded. Markets, much like life, operate in cycles. There are always going to be pullbacks, ugly margin call liquidations, and terrifying headlines. But in secular growth trends, while corrections are definitely inevitable, the foundational floor keeps rising. The bottom gets higher. So as we watch this incredible AI infrastructure revolution unfold, the ultimate question you have to ask yourself today is this. Are you going to get shaken out by the short-term noise, or are you going to patiently invest in the long-term reality?